How much pre-seed or seed capital should you raise for your startup? This is a really great question. And there's no real simple answer. I'm going to attempt to simplify it a little bit and give you sort of a framework to think about how much capital you should raise so you don't make a lot of mistakes that I see founders make. And then also you can communicate your fundraise in a way that makes sense for investors so they have more confidence to invest in you. So the question again, how much pre-seed seed capital should you raise for your startup? Let me just clarify here. Pre-seed is not professional capital. Pre-seed comes from friends, family, and associates, or like accelerators, very, very early stage. But even that is, I don't even consider pre-seed. Pre-seed is pre-professional startup capital investment industry. So it's going to come from your FFA rounds because professional investors don't do pre-seed capital unless you have an individual who's an angel investor who's willing to YOLO some money into you to figure some things out. Typically, it is all based on an idea and you're ready to, start validating it. You got a unique value proposition. You got to build an MVP, all that stuff. So we're going to talk about that. Seed capital is when you're in the game and you're going to be raising the seed capital to eventually get to the point where you're going to raise an A round, B round, C round, and then do some type of exit. But seed capital also applies if you're bootstrapping, which I'm going to delineate. Okay. So this is for all of you who are, want to explore the difference between bootstrapping or getting professional capital, i.e. venture capital. So it's important. Before I continue, is a disclaimer. This is all in my humble opinion. Everybody's got different things. Sometimes investors and other people get really salty with me in terms of how brutally honest I am telling founders don't raise investment or, something like that. They say, Ed, what are you doing? Type thing. You're screwing up our industry, what have you. And, I'd rather just give you my honest and humble, hopefully humble opinion. I think I've been humiliated and humbled enough through my days where, it's just my opinion. All right. So take all this with a grain of salt. But I think once you start to, think through some of the things I share, you're like, yeah, it seems to be common, pervasive logic out there and it makes sense. So disclaimer, my humble opinion in terms of this topic. Okay. Pre-seed, talked about what pre-seed is. How much should you raise? Well, the answer is enough to build an MVP that makes money and decide to keep bootstrapping or raise venture capital. All right, loaded statement. So enough to build an MVP. So you should only raise pre-seed capital once you have validated your idea and your unique value proposition. You've got a problem well-defined. You create a solution, what it's going to look like, and you validated it through experts and different people. They go, yeah, that makes sense. Because the last thing you want to do is use pre-seed money that comes from friends, family, and associates and blow it on building something that is not going to do anything for you. Right now, you can fail. You can build an MVP and attempt to make money, and it doesn't make money. No harm, no foul. Everybody should never invest stuff that they're not prepared to lose. And we know startups are inherently risky. But if you've done your idea validation, which involves customer discovery, and you've got your idea validation pitch deck out there, and you make an MVP, you should raise enough pre-seed to make money with your MVP. All right. And a lot of founders miss out on this. And again, my humble opinion only. But if you think this through and you go, okay, I'm only going to be able to raise, let's say you talk through it. I need to raise $100,000 because I can do that and it'll actually generate cash flow for me. Then that's what I'm going to spend it on. And so you might want to change the MVP that you're going to build. And because, I know people building deep tech and it's a completely different way to invest, but, they're going to raise pre-seed just for the research. And it's really tough. Someone has to super believe in you, which is the reason you go to friends, family, associates, because they may believe in you that you can figure it out and they're going to YOLO some money and give you, 50 grand and say, I don't expect to ever see the money again. Right. I've done those types of investments, not the $50,000, type thing. I put in, let's say 4 figures into an investment, 5 figures sometimes, say, I don't expect ever to see the money again, just so you can figure it out. But typically what happens is I want to know you got to build an MVP and you can actually make money. The reason you have to make money with it is because that's the signal. It doesn't have to be the final money. has to be just some sort of revenue. That's the signal that you are oriented as a founder. You understand that there has to eventually be a path to profitability, no matter how much you raise. And it's the best traction that you can get to go raise your next round, right? Now, here's the thing. If you do it right, you can decide to keep bootstrapping. Let's say you raise 100 grand, you build a fantastic MVP, and it's making you're projected to make $50,000 that year, right? You may decide, you know what, I'm going to bootstrap and I'm just going to, give everybody a nice return and, all these things. Now, bootstrapping could include raising more capital, not from VC, right? You might go to the bank and get a loan or different things, different venues and opportunities. So bootstrapping, you can still take money, but it's not for the same purpose of scaling something for, a big fat exit, right? To go public, which you're going to need, seed round A, B, C, D, E, whatever, put all the money in the war chest. So once you raise enough money to build your MVP and you have the option to bootstrap and you got traction, let's say you're traction and you're making like the money keeps growing. Maybe you're not making a lot of money, but the growth is great. And now you have predictable money where you're just like, okay, if I try these few experiments, maybe I can go raise a seed round, and the seed round's so much easier if you're raising money. So again, I wish I could give you a solid number. It depends on what you're going to build and what you can make money. I've had opportunities to raise hundreds of thousands of dollars, but I've said, no, you know what? I'm just going to take tens of thousands of dollars because I believe I can build an MVP that makes me money ahead of time so that when I do take hundreds of thousands of dollars, I'm in a better spot where I don't have to give away so much of the company. And I also don't have lots of people, investors and their opinions and, armchair founders trying to run the company for me. I don't enjoy that. So I go, sometimes I've said, and this is a luxury, I understand, but eventually, hopefully you get there and they say, Ed, how much money do you need? And they're like, we could invest hundreds of thousands of dollars. I say, I need way less than that because I just want to get to the next milestone and prove that I can generate revenue, right? But remember, it's going to be in different terms. The first investor always gets the best deal, and you may want to take more money. You might be okay with that and you take more money than you need, but typically, equity at that stage, pretty expensive to give to a pre-seed investor. Okay, next, seed. Okay, so pre-seed and then seed. If you're bootstrapped, and they gotta, split these apart. If you're bootstrapped, the answer is enough to never have to raise again while meeting investors' goals. All right, that's what I do. So if I'm bootstrapped and I want to stay bootstrapped, I'm going to raise enough money that I never have to raise again to meet investors' goals. And this is a moving target. Now, remember, you also are an investor. You've invested your time, resources, intellectual capital, all this stuff. What are your goals? If you're like, well, I need to be a billionaire by the time I'm 40, well, you're going to have to raise a lot of capital and you're probably going to go VC route. But if you're like, no, I want a good, solid, steady job. I want to be making $200,000 a year and be able to take, put another $100,000 away in profit every year. And I'm good. And I don't see myself running on the hamster wheel of startups and building a massive tech company with thousands of employees. I'm good if I can just grow this to a nice manageable company, 30 employees or what have you, raise enough money for that, and then never have to raise enough, money again. And that may be a continuous, raising capital as you do that, but that's what you do. You set your sights on, right? But if you're like, I need to make tens of millions of dollars, well, you probably have to raise millions of dollars. And that can still be considered bootstrap because you're not accessing professional capital, comes in different forms along the way. And many venues, many opportunities, different ways. Startup founders should consider there isn't always, you're not always forced to raise from VC. Okay. Lots of alternative financing options out there. Just go research and find out. All right. Now, let's say you get to the point where you are going to raise VC. You're sitting on a startup and you're like, oh, you know what? This is going to need lots of capital because we're going to scale this and go for world domination while, eking out a path to profitability. Remember, in the beginning, you're already figuring out how to generate money with your MVP, which today VCs are going to appreciate not just your growth or your rate of growth, but they're not into growth at all costs right now. They want to know growth, but what's the path to profitability? So the answer is enough to stay focused and find product market fit for a proper ideal A round or shut down. All right. Here's the thing. Founders, I've seen founders make huge mistakes. They raise millions of dollars at the seed stage, and then they go and they spend the millions of dollars building a product, and then they either run out of money or they launch the product and they got no customers. They don't know how to get it out there. So all been focused on, engineering and all that stuff. Not good. Not a good sign. I'd rather you take the $2 million and spend $1 million, build half a product, and another $1 million figuring out how to sell it and make money so you can raise your next round. Or say, you know what? Doesn't matter how good our product is. We don't, market timing's bad or there are other factors. We're going to shut this thing down because, startups fail. So everybody's going to understand, especially if you raise seed from, VC stage. So I say enough to find product market fit. So typically, if you're looking at it, like in my mind, I don't think you need to raise more than $500,000 to find product market fit, right? If you've done pre-seed, you got an MVP, you raise $500,000 to add some more features and to find product market fit, gives you a salary, brings on a technical person, allows you to build some staff, put some marketing in there, and raising more than $500,000, that's, really tough. Because guess what? If you raise $2 million in a seed, the pressure, if you don't have product market fit after, is so immense. But at $500,000, you may have good signs of product market fit in there. And I know VCs that will purposely give you less and say, we'll come on for another $500,000 because we think you're close to figuring it out, right? They want to know what you've done with small amount of capital. There's this adage or proverb or whatever it is where it says, faithful with the little, faithful with the lot. Figure out how to show that you can manage small amounts of capital, because quite frankly, what happens with founders, let's say you're really good at raising money and you have people you're on a baby unicorn sitting in a rocket ship ready to go to the moon, and everybody dumps capital in there. Well, the expectations are huge, and then access to too much capital. I had one investor tell me, someone who acquired one of my companies, my first company actually, said, Ed, access to too much capital leads to undisciplined decisions. And, that's what he said. And believe me, he had access to a lot of capital. And so I've always taken that lesson to heart. So I'd rather take less capital and be disciplined and build a great company, which is the reason building company during recessionary times, the strongest companies come out of that, right? The everything bubble is over. And when money was aplenty, you saw the quality of startups going IPO in 2022 drastically decline compared to all the previous years. Now everything's going to tighten up, and you're going to see a whole bunch of founders raise less money because there's less, people want you to be more disciplined, but build stronger, more resilient companies that are eventually going to win and going to raise tons of money, later on. So that's how you do it. All right. So there you go. How much money should you raise pre-seed and seed? Kind of giving you my humble opinion on what I think startups should do, how the advice that I follow myself for our portfolio of startups. All right. So there you have it. Hopefully that was helpful. As always, join us up on startups.com. We're the online on-demand accelerator community, and we're all about founders helping other founders out. Come check us out at startups.com. We're doing office hours, networking, groups, advisory all the time. And if you have any other questions or comments, please let me know. I always appreciate the feedback and always appreciate the support of people inside startups.com and outside startups.com. Thanks for watching this video. I just cherish when people, learn something from this. And so always appreciate your contributions and participation. Hope to see you in the next one.